questions in the chat. All right, let's talk fears versus fact. The number one fear, I can't afford to buy a home because my credit isn't very good. Well, guys, number one, there's options. Number two, the reality is you don't really know what your credit score is. It is very, very unlikely that if you are following Credit Karma or Credit Sesame or any of those things that you actually have a solid grasp on what the... Hey, Tanya, can you hear me now? Okay, awesome. My apologies. Anyways, it is very, very unlikely that you have a solid grasp on what your credit score actually is. A lender is going to use something called your FICO score. So it's going to look at much more than just the one or two credit bureaus that those places are pulling. Oftentimes, it's actually a lot higher than what we see. That's what I found. So the best bet is to go ahead and talk to a lender, let them run your credit. It's a soft pull. It's not going to hurt your credit, and give you a plan. Roosh is never going to tell you no. He may say not right now. That's the reality for everybody looking to purchase a home, right? There's never not a good time to see if you can purchase a home because our lenders are always going to put you on the path to it. Now, if you shouldn't purchase a home, that's a whole other conversation. We definitely want to talk to you through that. There is absolutely reasons to rent over purchasing. And we'll talk about that a little bit later. Or we can talk about it now. So I should wait until I'm married, or I should wait until I'm certain about my future. I'm going to stay where I'm going, or all of those things. And the reality is, yes, there are good times to buy houses and bad times to buy houses. And if you know that you're going to move in 6 months, it's probably not a good time to purchase a house right now. Likewise, if you know that you have a life change coming up, that's going to require a big move, you may want to put this on the back burner for a little while you focus on life. I mean, we all have families, and the goal here today is to just teach you how to become a homeowner, not to pressure you into anything. Buying a home seems too complicated. Well, sure. Buying a home it can be complicated. If you have the right professionals on your side, though, we're going to explain and educate you on everything. So we really want to make sure that we answer those questions and you go into owning your new home confident and ready for the future. Should I pay off my student loan debt before buying a home? This is a great one because, quite frankly, everybody in today's world nearly has student loan debt. That's going to be an individual circumstance. Most people use their monthly payment to go against your DTI to tell you what you will afford. So most people do not pay off their student loans prior to purchasing a home. Most people just use it as a bill.
Ham sandwiches.
Someone talking to me?
Sandwich today. I
think you just need to ask everybody to mute.
They should have came in on mute. There we go. Okay. So student loan debt does not prevent you from buying a home. Will it affect how much you can afford? Absolutely. The same as a car payment will affect how much you can afford. The same as credit card debt will affect how much you can afford. However, student loans are very real and very common when purchasing a home. So do not think that you need to pay off your entire student loan debt before you purchase a home, because that is just not the case. I can't afford to buy a home right now. This is one that we hear a lot. And I want you to think of it like this. When you are renting, you are paying someone's mortgage. It's just not yours. So every dollar that you put toward your rent is going to someone else's mortgage, someone else's equity, because when they sell that property, they're going to capture even more money. So I always like to explain home ownership as almost like a forced savings account. every payment that you make every month, a little bit is going towards the balance of your loan, and not only that, but while you're staying there, you are gaining equity. So when you sell that home, oftentimes we find that our clients have been able to live in that home for 4 or 5 years and have made enough of a profit that it's almost as if they never paid a mortgage to begin with. Does that make sense to everyone? When you sell your home, it is very likely that you will have a profit off of it. And you are paying that loan debt down so that when you do sell the home, again, you'll just pay off the rest of the loan. Now, also going back to, you really want to talk to a lender. Most people just don't know if they can afford to buy a home right now. They just don't know. But the reality is, if you're paying rent, you're also paying a mortgage. It's just not yours. You're putting the benefits of home ownership into someone else's hands. So when they go to sell that property, they're making money. They've made money the entire time. But when you go to move that property, all you've done is lost. It is completely different when you're a homeowner.
Hey, Amanda, Journey had a question. Can I ask you really quick? I don't know.
Yeah.
Okay. She said, what if you don't have to start making payments on student loans? Should we start so they can see that you are making payments?
Hi guys,
Bruce, can
this
you
is
jump in on
Rich.
that?
Yeah, absolutely. First of all, nice to meet you, everybody. So regarding your student monthly payments, it goes case by state depending on how much student loans you have. I don't recommend you start making those payments just yet. Once I review your file, a lender will tell you if if your student debts are too high or they need to be lowered. We technically have to take 1% or 0.5% depending on the loan program. We have to account for it, even though you currently aren't paying a payment on it. So that's a really good question. It all depends on what type of debt to income ratio you have and how much of a student debt loans you have. And there's ways to actually make that even lower, and we can get into that too. I'll be more than happy to, do a one-off with you later on that.
Yeah. So in short, no, don't start making those payments because you want Roosh to look over your credit profile, and it may honestly benefit you to have a $0 payment and only have to use that 0.5% towards your debt to income ratio. I hope that answered your question. All right. I don't have the money for the down payment. Well, guess what, guys? You don't always have to have a down payment. I know a lot of people are stuck in that cycle of believing that you need to have 10, 15, 20% down. But the reality is we have lots of excellent programs, and those programs are designed to make first-time home buyers homeowners. And a lot of those programs allow you to purchase with 0 down payment. You will have some other costs along the way, and we'll talk about those shortly. But the great thing is those other costs are negotiable. So if you can get the seller to pay those other costs and you use a no down payment loan, then guess what? You have just purchased a home with no money out of pocket. It has happened multiple times in my career. I have even had clients come to closing and then walk away with a check because we were able to get most of their costs finished or paid for by the seller. So it's a case-by-case basis and also a house-by-house basis. But you do not always have to have a down payment. So please do not let that stop you from speaking to a lender. And then the next fear is I can't afford to buy my dream home. And this is my favorite one because I always want to say, most people can't afford to buy their dream home right away. Most people start in a starter home and then they sell that home. And then with that equity, they purchase their dream home. Or some people will start in a starter home. They will hold that home. They will create it as a renter or turn it into a rental, use the equity to purchase their next home, do the same thing, and then build a whole rental portfolio before they even buy their dream home. So I want you to think of every purchase as an investment, as a savings account. That is the best way for me to explain it to you guys. It is an investment in your future. Most people cannot buy their dream home right away. I know that for me, for example, I had to sell 2 houses before I was able to build this home that I'm in now. And quite frankly, you don't want the payment on your dream home either. And so that's what buying that first home allows you to do, is to keep those payment lower as you move up and you move your equity into your next home. 6 easy steps to home ownership. Number 1, hire your agent. Hopefully you guys will use one of us. If you don't, I hope that you have a wonderful agent. There are lots of wonderful ones out there. Second, secure pre-approval financing. Roosh is here for that. We also have several other trusted lenders, but Roosh is one of the best out there. So we highly suggest you reach out to him. His contact information is in the chat, and we'll also be able to scan a QR code here later if you want to get in touch with him. By the way, guys, I just let a couple of more people in. If you just got here, please make sure you're on mute. And also, please drop your name, phone number, and email address in the chat. This will allow us to contact you if you're the winner of our contest at the end. And it will also allow us to send you the recording if you wanted to share it or go back and revisit any of this information later. Number 3, find your home. That's the fun part. That's when we get to go shopping. Y'all, people are wild. Looking at people's houses are my favorite thing, especially if they're actually lived in. Then 4, making the offer and negotiating. This is where those emotions come in. We're gonna get you through it, I promise. I always like to tell my clients who have had children that if you are purchasing a home for the first time, it's very similar to being pregnant or expecting your first child for the first time. It is an emotional roller coaster, but the ending is so worth it. Number 5, get your home inspected, negotiate your repairs, and get your insurances. And number 6, close and be a homeowner. I mean, it's really that simple. So start with hiring your agent. As your agents, we will educate you. Number 1, we are always going to lead with education. There is no dumb question. Please ask us all of your questions. Also, don't be embarrassed to put them in the chat, because if you have a question, it's very likely that somebody else here has that same question. Analyze your wants and needs. We're really going to talk to you about what you want and what you need. You may want that dream home, but you may only need a 2-bedroom for right now. So we're going to analyze that and make sure that you're getting the home that fits you best now. Help find homes that fit your criteria. This is important, right? I'm not going to show you a $700,000 home if you can only afford a $400,000 home. That's also another reason you want to make sure you get started with your pre-approval right away, because if you are looking at houses based on what Zillow says the payment is, it is completely skewed and wrong. So what you think you can afford and what a loan product says you can afford are 2 very different things. So please don't break your heart before you've even started the process. We see that a lot where someone comes to us and is like, I found this house, I love it, I want to get pre-approved right now, I want to buy this house, I want to put an offer, and I pay this much in rent, so I should be able to afford it. The reality is what they've done is they've looked at the Zillow's estimate, and yeah, they do pay that much in rent, but that estimate is only taken into account a conventional loan with 20% down, and it's not considering taxes, insurance, or any of the other things that you would have to consider. So please keep that in mind. Lender is your first step here, after us, of course. Coordinate the work of other professionals. You've got appraisals, you've got multiple inspections, you've got title companies and attorneys that you need to be in contact with. We're going to take care of all of that. That is not something that you need to be concerned with. We have staff for that. And quite frankly, it's just a lot. And if you're not in this business every day, it's an awful lot to understand and try to coordinate yourself. Fun fact, you can Google this if you want. 80% of real estate litigation comes from for sale by owners. So that is just a little small look into how the many intricacies of real estate can really mess with you if you don't have professional guidance. Negotiate on your behalf. We are pros in negotiation. That is what we do. So while Whitney is here. I'll give you an example. Just this week, we were able to, without even telling our client, negotiate. We knew that our client would take the offer that we got, but we were able to negotiate it so that it worked out $3,500 in the positives for our client, which was just excellent. Hey guys, if you just got here, please put your name, phone number, and email address in the chat so that if you are the winner of our contest, we can reach out to you. And also at the end of this, we can send you the recording since you missed the first few minutes here. Solve any problems that may arise. These are problems that you probably won't even know, honestly. That's what's great about having an agent that has your back. Most of these problems we're going to be able to solve before you even find out about them. And sometimes there are problems. And then walk you through hand in hand the entire process. Again, our whole mission is to lead you with education, the best education possible. We're experienced in this. We've been doing it for a long time. And it's just an extensive and confusing process. So having the right person have your back is key to making the transaction go smoothly. Whoop. Now, the first thing that we're going to do once you have an appointment with us is we're going to ask you to sign a buyer's representation agreement with us. What that does is it sets mutual expectations in writing. So it says, hey, I'm going to work for you, and you're going to agree that you're going to work with me as your agent. It commits me to finding the perfect home for you. So it's going to say, I'm going to search the MLS. I'm going to search FSBOs. I'm going to prospect on your behalf for sellers that may be interested in selling. It allows me to do that for you. And then it's going to confirm exclusivity between the both of us. So once again, you're going to work with me and I'm going to work with you, and we're going to be exclusive so that we can get you to your end goal, which is owning the home. So this is just a quick little timeline. Start working with me, finances in order, pre-approval. So start looking under contract, close, move into your home, last lease payment. I love that because a lot of people do not realize that when you go to close on your new home, let's say you're going to close on it in May and your lease is also up in May. Well, guess what? Come June, you actually don't have a mortgage payment most of the time. So your first mortgage payment is going to be due July 1st. It's not going to be due in May. It's not going to be due in June. So you actually have a cushion to be able to pay your last lease payment and also stay there if you wanted to paint or make it your own for a month. Step 2, secure pre-approval financing. Choose your lender. Again, we have Roosh here with us today. He's going to go into this a little bit more here on the next slide. There are thousands of loan products out there. So I guess probably the easiest to explain is a lot of people come to us and say, okay, well, I want the first time home buyer loan. And what most people mean when they say that is FHA. And they just don't realize that that's what they mean. But the reality is there's hundreds of first time home buyer loans out there, hundreds. And not every lender has the same products. One of the great things about Roosh is that he's got multiple products from multiple different vendors. And he's been able to beat some interest rates pretty well here recently, which is awesome. All right, so why is your credit score important? How do you determine how much you qualify for? How much do you need towards down payment and closing costs? Roosh, you want to tell us that?
Yeah, definitely. Absolutely. So credit score, first thing and first. Credit scores, they can range from the 500s to 800s. And depending on your credit score, it allows you to get a better rate or qualify for a different loan product. For example, FHA for first-time home buyers, you could have a slightly lower credit score and still get approved for it. And then conventional, usually, you want a pretty decent score. I would say 700s and above. All loan products, we'll get into that in a second. They are really, we tailor those for different clienteles depending on your needs and your situation. Sorry about that. Can you hear me?
Yeah, we can hear you.
Okay, sorry. By the way, guys, pardon me. I'm at the Stonecrest Medical Center. That's why I was just getting a call. So let's jump a little bit into it. Amanda talked about DTI. When a lender looks at your DTI, what we're looking at is your income versus your expenses, monthly expenses. Okay. Some expenses that are included usually will show up on your credit report, such as your car payments, your student loans, any financing like your Amazon card or Best Buy card. We take account for all that stuff. Something that are not included, utility bills or your rent payments. We won't count those. Your loan to value, the LTV is our term for it. Loan to value is basically how much your loan is and how much down payment you're putting, and it's accounted for in percentages. For example, if you were putting zero money down, like on a VA loan or a USDA loan, your loan to value would be 100. On a FHA, it would be 96.5 because you're going to put down 3.5%. On a conventional first time, it'll be 3%, so it'll be 97, and so on. Closing costs. Closing costs are all fees and closing attorney fees, taxes, escrow accounts, all associated to what it's going to take you to purchase that home. There's different things on there for different types of loans. APR and your rate, they're two different things. What your rate is what your interest will be on the loan, and your APR is that broken down annually. APR is going to be always higher, just a little bit, because it includes certain fees, financing fees. Discount points, a lot of times you should see this if there is on your loan, how much discount points you're having to pay to qualify for a certain loan. Or if you want to buy the rate down, let's say the rate is 6.5, and you're like, if I can get it to 6%, what it would cost me to get that. So that's what that discount point is. Amanda, could you click on the next slide, please?
Of course. How do we
Awesome.
determine how much you?
So we just went over this DTI, types of different payments that are included in your debt to income ratio. Like I said, mortgage, monthly mortgage payments, which your new house will be, your credit card payments, and those are minimum credit card payments, your auto loan, student loans. Student loans, back to that question Jeremy had earlier, student loans, even if they're deferred, we do account for 0.5% or 1% depending on the loan product. And don't start paying those, because once you do, we have to account for those with what you're actually paying them. So we can guide you in that case-by-case basis. Installment loans, such as a car or a loan from Paycheck Cashing Company, those will come up too. Monthly payments that are not included again, services, insurance, daycare, rent, all those utility bills, your Comcast bill, they're not going to be on there. So I wouldn't worry about those. The best way to get started is pick up the phone, call your lender, whether it's me or somebody else. They'll advise you and they'll walk you through the whole process. And then will you click on the next slide, please? All right. So this is how your monthly debt to income ratio is calculated. You would take what your housing expenses, which your mortgage will be, which includes interest, principal, your insurance, taxes, HOA if there is any. And then you would add your other debts on it, like your student loan, for example, and then your credit card payments and etc. You would just divide that by your monthly income, and you're going to get a percentage. Now, right here at the bottom, it says max DTI is 45%. That's a good guideline to go off of, depending on the loan type. Some loans allow for a slightly higher DTI. Some loans are a little bit more riskier, so they will allow for a lesser DTI. And then we go case by case, depending on what type of loan product suits your needs. And will you click on the next slide, please? All right. So again, your monthly mortgage payment, this is everything that it consists of. First is your principal amount, which is your entire loan amount. The interest that you'll be paying to finance a loan. Taxes, we have to pay Uncle Sam no matter what. Insurance, we have to make sure your home is protected. And it's just not you. It's also, what your loan amount is. And then that's where mortgage insurance comes in next. If you put in less than 20%, you don't have to pay that mortgage insurance. All that does is says, hey, in case you default on it, the bank has insurance on your mortgage. All right. So here, there's some basics, lending basics, different loans types we have. There's some different percentages of down payment we have for different loan types. There is a home buyer's educational course, which I highly encourage you to take everybody. I myself will sometimes sit with through my borrowers to kind of assist them and walk them through it. It's a very good refresher, even for professionals. It kind of allows you to see every single aspect of it, and it changes usually on an annual basis.
I
There's
100% agree.
PMI.
I've taken this twice.
I love it. You learn something new every time.
Mhm.
And things in this business, in this industry, they're changing every day, just about. Your debt to income ratios over here per loan, your credit scores, your if there's gift funds allowed or not, and then if you have gone through a credit occurrences like a bankruptcy or foreclosure or something like that in the past, this kind of gives you a guideline of when you can start shopping again.
Can I
So
interject
up
real
top,
quick here?
yeah, absolutely.
So I wanted to explain what gift funds are. I think that that may confuse some people, but essentially, if mom or dad, or even if it's your second cousin twice removed, I don't even know how that works, honestly, wants to gift you any money on your behalf, they can. Now, there is a disclaimer here. They cannot Venmo it to you. We have to be able to track it, and there has to be a gift letter that accompanies it. But your parents, let's say you're engaged, but only one of you is going on the loan, your fiance could do a gift fund, things like that. And then also, I wanted to break in on the bankruptcies, foreclosures, and short sales. This is a great chart, because so many people think that foreclosure is the end of their homeowning journey, or bankruptcy is the end of their homeowning journey. And it's just not. I mean, you can see here that you can be just 1 year removed from bankruptcy and still purchase a home. That's all I wanted to say.
And that's from the filing amount. So you have, you can start right away actually, and at least prepare yourself to, plan ahead. FHA right there on the top, it says 3.5% down payment. That's the bare minimum that you can put down on FHA. Conventional is 3% to 5%. The reason it's 3 to 5 is for first-time home buyers, for Home Ready Home Possible. That's a whole different product. You can qualify to put less money down, and it actually comes with less PMI. USDA is 0 down. That's a rural development loan. We can get into the two later. VA, if you're a veteran, thank you for your service. It allows you to buy certain type of loans with no money down, and a lot but other benefits too. Conventional 97%. That's at 3% it's on the left side as well. This allows you to, it's mainly for first-time home buyers. Now, it don't have to technically be a first-time home buyer. As long as you haven't owned a home for at least 3 years, you qualify for those programs. And those programs have really good benefits, such as, you can start off with a lower FICO score, your debt to income ratio can be a little bit higher, and your mortgage insurance is also lower, and you get a slightly better rate. And then there's THDA. THDA is a really good home buying program that allows you a down payment assistance program. They have 2 different types. They'll give you $6,000 that you put towards your closing costs or your payment, or they'll give you 6% of the loan amount. Total 3. Sorry. So on that one, you can essentially get into a house for almost nothing, as long as you have some seller credit, which Amanda was talking about earlier, that we see this all the time, where if the sellers are giving you a certain amount of credit, then you can have a program like this will come in and step in, and you basically have almost no out-of-pocket expenses. All right. And then if you can, now right here, there's credit scores on here, where it starts from 600 to 620. As you see, conventional loans are a little bit higher. FHA is at 600, but we do have loan products that you can go down to even 540 and 560. Some of those, and we understand that life happens. I've had a family member who is a business owner, went through bankruptcy because of his business and dropped his credit score, but he was still able to buy a house. He just had to pull up some additional funds. And then, if those are some private conversations that we have with our clients, so we can get on one-to-one basis on that as well. All right, well, you switch the slides for me. All right. So this is slightly a mortgage process that ties in with the entire home buying process and the timelines for it. Usually a pre-approval, I do it in within 24 hours, 48 hours sometimes, depending on how fast you get me the documents I need. Some of those documents that we look for, we have to have your ID because we want to make sure you are who you are. We have to have, in pay stubs for maybe 30-day pay stubs, 2 years of W-2s if you have it, or tax returns, and then asset statements just to see if you have any assets. If not, we can provide you with down payment assistance programs as well. So we ask for all those, and then we go back and circumnavigate and say, okay, which program best fits for you? What solutions is a good solution for you? And then we let you say, okay, here's ABC. You tell us what you think is better. Once you're pre-approved, you can start looking for homes. The team right here, they're amazing, Amanda and them. They will be with you entire process 7 days a week. They're amazing, and they will help you find you exactly what you're looking for. Once you do that, we finalize the loan once you find the house. That usually takes a couple of days for it to go from contract to disclosures. And then we order appraisal. That would be one of the first steps after you do that. The appraisal we have to have for lending purposes, because we want to make sure that the house appraises for what we're going to give you the loan amount for. And then processing and underwriting usually takes 5 to 20 days, depending. We've done it in 10 days, and we've done it in 30 days. So it just depends on how fast we want to move. And then pre-closing. Pre-closing disclosures is basically we review your finalize your documents and everything. The underwriter will tell us, hey, exactly what your cash to close numbers are. Title company will balance. Uncle Sam will send us, hey, these are your taxes. This is what you owe. We'll get quotes from insurance companies, whichever one you choose. They'll provide you a quote. And then we go into closing. Then once you're closing, you're done. Once you sign off in the paperwork, you got the keys. And then the last lease payment, like Amanda says. And depending on when you close, you can have up to 2 months of no payments. Majority of the time is 1, but at least 2 sometimes, just depending on when you close. All right, we switch to the next slide. Pardon?
I said, I always think that that's so great because people don't understand that they can actually stay in their apartment and pay another rent payment without having to do double payments.
Oh, absolutely. Yeah. Yeah. It happens depending on the time. Like I said, you can have up to 2 months. Some of the things to maintain your pre-approval, and have another slide for this as well. These are, once you start looking for a home, it's very important that you don't go make big purchases. You stay on your track of your budget, save as much as you can in the meantime. Don't open any new credits or debit cards. Don't close any bank accounts. Don't change your job. Try not to change your job unless you're getting, you're in the same industry or getting a raise or moving upwards. I would highly suggest not to change your jobs, because that can definitely it will affect your pre-approval. And then protect your down payment and closing costs. Don't spend it. Emergencies and life situations always happen. It's understandable, but try to actually save more, because it's only going to help you in the future. All right, we'll click on the next one, please. All right, and there's my info also. And then also you can scan any of those QR codes from the videos, and that will take you directly to my site. My cell number is right here. You can feel free to reach out to me. You can text me. You can call me anytime. I'm available 7 days a week.
Hey, Roosh, couple of questions.
Absolutely.
Alexis is asking how much they should put back for closing costs.
So closing cost, it depends on your purchase price and your loan amount and everything, depending on the loan product. I usually would tell my clients 3 to 3.5%, 5% max. So you want to have somewhere between 3 off the purchase price. Yeah. So about 3 to 3.5% is a really good ballpark number.
So if you were going to do a $500,000 loan, that would be
about 25.
25. However, again, those are things that we can work with the sellers. That's what we're talking about with seller concessions. A lot of times we can get closing costs paid by sellers, depending on the house. So it's all in the negotiation tactics.
Absolutely. And if you don't have this,
one other thing.
Yeah.
If you would address if one spouse, let's say, has a bankruptcy or something like that on their credit, how does that get addressed?
if one spouse has a bankruptcy, it
That was one of
depends.
the questions in the chat.
Okay, gotcha. Sorry, I missed that. If you files bankruptcy, doesn't that miss it? So if you file for bankruptcy in the middle of your home purchase process, that will hinder you, and then we'll have to go back and reevaluate. Can your spouse buy the house just by one spouse, or the other one has to be on it? We can rework the numbers and see. But things such as if you're starting a divorce in the middle of your home buying purchase, or if you're filing for bankruptcy in the middle of that, or you're opening a new credit card in the middle of it, or you go buy a new car, all those things can and most likely will affect your pre-approval, and not just pre-approval, but your loan amount or your loan.
But if you,
process.
I think what they're asking is if two people are married and one person has already filed bankruptcy, can the other person still purchase a home?
Yes, 100%. Absolutely. And a lot of these bankruptcy situations, there are guidelines for it, and there's usually ways around it, unless it's a hard no at timeline or something like that. Once we have supporting documents, if you have a good lender and a good underwriter and a good team, basically, we will be able to walk you through it and ask you certain questions to kind of get that out of, documentation, supporting material to kind of help us with it.
Love that.
Never, in this situations, never ever feel isolated or like you can't do it. There's always, I would say, there's always a way to make it happen. And if not, usually we get you in a game plan and make a plan out for you and say, hey, this is what we need to do for the next 30 days, a couple months, 6 months, whatever, to get you into a house.
And on the other side of that too, I can't remember who asked that, but on the other side of it, if you are married, we run into this a lot where someone is like, okay, well, she's approved. Now I don't get to be on the home. If you are married in the state of Tennessee, we are a marital property state. So if your spouse purchases a home, you still have a portion of ownership in that home, even if you're not on the loan. So you do not have to be on the loan to own that home, technically. I hope that makes sense to everybody, but that's the best way to explain it is the loan can be based on just the wife or just the husband, but the wife and the husband still has ownership and still has rights to that home.
It does. I get that a lot. That I have a lot of self-employed borrowers, for example. They're always like, "Hey, my financials are iffy. So let's just do it into my wife or husband's name," and that question always comes up, and we have to reassure them that in Tennessee, they're getting some of it no matter what.
On the other hand, some people are not very happy about that, but it is what it is.
Well, that's true too.
All right, step 3, finding your home. This is the fun part. Like I said, I love looking at homes. I think my whole team can attest to that. It's one of our favorite parts of this career. Our career is definitely way more than showing homes, but this sure is fun because people are fun. So to find your home, what we're going to do, we're going to find out what you're looking for. We're going to take you through several questions, ask you your must-haves, ask you your wants versus your needs. And then we're going to teach you about the market. Once you choose your home, we're going to run comps on that home to make sure that you're not overpaying for that home, for example. And we're going to refine that search so that you're not swimming in a world of Zillows and Trulias and Yahoo Homes and whatever else is, but everything that comes to you and everything that you look for fits within your criteria. So this is the part of the presentation where I always like to ask when is the person who was most recently on Zillow? So who was the last person on Zillow? Y'all can put it in the chat. I know y'all were, or raise your hand. I know you guys have been on Zillow. A month ago. Nobody can beat a month ago? Really? Come on. This is some people's favorite pastime. There's whole TikTok accounts dedicated to looking at Zillow. Today. Told you. All right. So what are you looking for? You're looking for if that house works for you. Is it a location that you want? Does it have the amenities that you want? Does it have the space that you want? The layout, all of those things. What are we looking for? We're looking to make sure that you're not overpaying, or on the flip side of that, if you are underpaying, to make sure you are really getting a deal. We're looking to how it compares to other homes recently on the market within that same area to make sure, again, that you're not overpaying, or if you are underpaying, you're getting a good deal and you know exactly what you're purchasing. We're looking at your resale. How much is this home going to appreciate for you based on statistics over the next 3, 5, 10 years? And then we're also looking for big ticket items. I always like to say when I enter a home and I go into the showing, I want you guys to look forward and around. Picture yourself. Does your furniture fit there? Can you see your dog in the backyard? Can you see yourself making dinner at that kitchen? And what I'm going to do is I'm going to look up and down and look in all the corners. And if I see something concerning, I am definitely going to point it out to you. But that is also why we have inspections. Next, you have to decide condos or townhomes. And there's a kind of a second here too, or investment. A lot of people do not realize that you can use these no down payment loans to purchase multi-unit properties. So you could purchase a duplex as long as you're going to live in one side. You can purchase up to 4 units as long as you're going to live in one. And it's a great way to start your rental portfolio so that you can reach that dream home later and kind of jumpstart it. But also you have condos and you have townhomes. Condos and townhomes in Middle Tennessee are kind of the same thing, but in regards to lending, you will want a professional on your side, because we do have to make sure that if it's deeded as a condo, your loan product will sell it to you. I know it's one of those many intricacies of real estate, but it's a reality. Now, if it's deeded as a townhome, that's great. Any loan product should be able to cover it as long as it meets appraisal standards, yada, yada. If it's a condo, we will have to check it, but it's very rare to see one or the other here that's not approved. Now, the pros of buying a condo or a townhome. Yes, you can purchase up to 4 units with no down payment loan. I know, it's called house hacking. We have a whole seminar on that as well. I think it's coming this summer, but you can always visit our YouTube page. I believe it's up there. Just Google the Music City Lifestyle Group. Pros to purchasing a condo or townhome. Well, number one, it might be a little bit cheaper, lower cost per square foot. Also, if you're like me and you just really don't want a yard, like I don't do yard work, y'all, then a condo or townhome might be for you. Also, if you want to live downtown or you want walkability, condos and townhomes are more likely your speed. They also have amenities, swimming pools, playgrounds, things like that, and a sense of community. Cons, shared ownership of the space. Your attics may connect. If your neighbor has a bug problem, guess what? You probably have a bug problem that is now going to infuriate you. Don't let that keep you back, because most homeowners do not have bug problems, but just an example of what might be a con. It's also managed by a board of directors, so they have a say over what happens on the exterior of your home. A lot of times it'll be things like making sure you're keeping your bushes trimmed, making sure that your gutters aren't like, falling down, or your roof isn't caving in, or you haven't painted your door like orange or anything against those rules. But there are rules that govern these things. So you will want to make sure there you go. Whitney said, I live in a townhome and that's not an issue for me, even when my neighbors have it. I think that may have been a bad example. That's true. It was an extreme example. Anyways, they are governed by rules those rules you have to abide by. And you do have to pay your homeowners associations. So pros and cons of condos or townhomes or single family home, or again, you could also purchase a duplex or up to 4 units. New construction pros and cons. Well, pro there is it's new. Another pro, you're going to have probably a 1-year warranty from the builder. So if something happens, they're going to come back in and fix it. You a lot of times we'll get to pick your lot, your features, and your designs. Sometimes you can get good deals on them because they build a lot. Your cons, they are a little bit more expensive than a traditional home that you could just make your own. The options that they give you to purchase while you're going through the process, a lot of times can be found cheaper after you close on the home. The future of the neighborhood there's no comps, right? We were talking about comps and statistics and being able to tell you how much you'll appreciate. We don't know that yet because the neighborhood is new. Amenities may not be done yet. Sometimes, I know one subdivision in Lebanon, they started moving people in. They had to make sure that they let everybody know the pool actually wasn't going to be put in until the final phase was completed. So it was about 2 years later. So you may be purchasing amenities that you don't have yet. And then the last con is there's just no firm closing date. And basically so many things have to come together in order for you to meet a closing date. You've got multiple state entities that have to come out and do inspections and give permits. And you know how it is, none of those different places work together or share systems. Then if there is weather delays, like, recently it snowed, that is definitely going to push back several people's closing dates and finish dates, things like that. So you don't really have as much leeway as far as your staying in an apartment and moving into your new home and not having to worry about rent in between there. Step 4, making an offer and negotiating. Number 1, what we want to do is we want to make sure it's a win-win for everybody, right? Buyer and seller. Everybody wants to come out of this process in a good mood, so to speak. One of my favorite things about real estate is that I'm constantly with someone on the best day of their lives. And so we want this to be the best day of your life when you close. At the same time, we also want you to make a good deal. We are going to be truthful for you. We are going to look at those comps. We are going to look at the neighborhood. We are going to look at other homes that have sold to make sure that you are offering true market value. If you come to us and you say, hey, I love this house, but I want to offer $100,000 less, we are going to be truthful for you. And we're going to tell you, hey, we might write that offer for you and that's fine. But if you really, truly want this home, you may really upset the owner and they may decide to just not work with you at all. So I would suggest offering something more in line with the comps that we've pulled. Your terms. So these are categories that address, these are your timelines basically, right? So maybe you have 10 days for your inspection, your closing date is in June, you're using an FHA loan. Those are all terms in your contract. And then you have conditions. We call those contingencies. These are things like financing. If you have a financing contingency, which probably everyone here today would, most people do, then that's going to follow you all the way to the closing table. If for some reason you lose your job 2 days before closing, nobody's going to force you to close on that home. You have a financial contingency. You're going to be able to walk away from that contract without any further legal ramifications. You also have inspection contingencies and appraisal contingencies. So if the home is not worth what you are under contract for, then you can walk away with no further legal obligation. Inspection, repairs, and insurance. Inspections are always our clients' scariest part of the process. The looking at the homes is fine. Honestly, the negotiations are fine. The inspections are where it can get kind of scary, just simply because When an inspector comes in, they're looking for everything. Now, most of these things are not bad. Most of these things are normal things that a home has. No home is perfect. Homes are built by people, and people make mistakes. So no home is perfect. Every home is going to have little things, cosmetic or otherwise, that you're going to have to keep up with or fix in the future. Now, what the inspection is really looking for are those big ticket items. So your structural issues, your roofing, your HVAC, anything like that, your plumbing. They're really going to look for that. There are also multiple different inspections you can get. Say if you were purchasing a home with a pool, you could get a pool inspection. Your inspection period is one of those terms that we were talking about. So it's usually 7 to 14 days after your accepted offer. We kind of depend that on, it's kind of dependent on when you want to close. A longer closing date allows us for more time for an inspection period. Shorter closing date means we got to get it done quicker. So usually it's 7 to 14 days after your accepted offer. We like to go ahead and get those scheduled right away. We do have several preferred inspectors in the area, or you can choose your own. And again, going back to, don't worry about the small stuff, right? If there's a piece of crown molding and it just needs to be nailed up, that's not a big deal. Now, if there's a huge crack in the wall, that may be a sign of some foundation issues. Water stains, indicative of leaks, right? The roof, that's a big one. Our inspector gets up, it's going to take pictures of the roof, make sure the roof has the eaves and everything have been installed correctly, let you know an approximate age of the roof if we don't know the age. The roof is a big one. Plumbing and electrical problems, mold and termite issues, and unlevel flooring. Unlevel flooring is here because that is usually indicative of a foundational issue, although I do want you to know that if you are looking at older homes, the older you get, the more unlevel they are, just based on wear and tear over time. And then you close and you're a homeowner. So we talked about budgeting for your additional expenses. The closing cost, 3 to 6% of the loan amount, which is exactly what Ruth said. Again, these are negotiable costs that we may be able to get the seller to cover. It is a matter of each person's unique situation and the house they choose. So it is negotiable, and that's what we're pros at. Your earnest money is a good faith deposit. Basically, what this means is you put this money down, a title company holds it, and it just tells the seller, hey, this money is going towards my purchase, and I'm serious about it. I'm serious about it. And if for some reason I walk away that doesn't have to do with one of my contingencies, doesn't have to do with my financing contingency, maybe I just got to closing and I still could purchase the home, I just decided I didn't want to, then that is what that earnest money is for. Only if you walked away without utilizing one of your contingencies would the seller get to keep that earnest money. That is your money. Even if you get to closing, it goes towards your purchase. Or that is where I was talking about. Sometimes I have gotten to closing and we've had everything taken care of, and the buyer has actually left with a check. It is usually that earnest money. Inspections, these vary because, again, there are multiple different kinds of inspections you get. Just a basic home inspection, it does vary per square footage. We see those ranging between $300 and $500 in our area. The more things you add on, like radon, plumbing, it goes up. Survey. This is not required by any means. In fact, I would probably say if you're purchasing in a subdivision, that developer had it surveyed, it's recorded, you wouldn't need to have a survey. But this is necessary if you're thinking of purchasing large tracts of land. So maybe anything over 2 to 3 acres, you may want to have a survey. Any miscellaneous fees that come up, what we mean here is, like, let's say, for example, you have an inspection and you're like, oh, this is bad. I don't want to buy this house. I've decided that I cannot, in good faith, move forward with this purchase for my own self. Then you're going to have another inspection fee, because that inspection fee is not going to come back to you, but it is going to be able to, but you are going to get out of the contract. And then 1 year of homeowners insurance. Not all escrows will require 1 year of homeowners insurance. It's just a good estimate. I know my homeowners insurance per year is, I think it's $1,900 a year. So it's not overly expensive, but it is good to have those on hand, especially if you are doing a loan that does not require escrow. And then you get to closing. And what do you bring? You just bring your funds. A lot of people wire them nowadays, so you may not even need to bring those. Evidence of your insurance and a valid ID. And also, again, the insurance, we work closely with many insurance agents. They'll just email the proof of insurance to us, and we'll take care of all of that for you. So you just gotta show up with a hand that's ready to write and a valid ID. And you're gonna get a settlement statement. You're gonna need that for your taxes. And we also do mail those out in January of every year. You're gonna get a transfer of clean title, and you're gonna get keys to your new home. Next, you're going to make sure your investment is protected. So not only are you going to keep that homeowner's insurance on it, you're going to maintain, make sure you're performing routine maintenance on your home, getting those HVACs checked every year, making sure that you don't have leaks, damage, things like that. Fix those small problems early. Keep a file of your receipts for your repairs. Some of these things are able to be written off on your taxes. So definitely keep all of your home ownership and stuff in one place. And you can also consider a home warranty. That's one of those things that also is negotiable with the seller. Sometimes we can get them to provide a 1-year home warranty for you, but you can actually purchase these on your own as a homeowner at any time. And they help cushion you if something large happens so that you are not coming all out of pocket. For example, we've had multiple hot water heaters or water heaters be replaced. We've had HVACs be repaired. We've had refrigerators be replaced and repaired. So yeah, you can consider a home warranty. And next is just asking any questions that you have and getting you guys ready. So does anyone have any questions before we end here? Feel free to unmute and come on if you do.
Even if you don't have any questions right now, make a list. Feel free to email those to us. I'll be more than happy to answer, and Amanda will as well.
Well, thank you so much, everyone, for coming. We will get these recordings out to you. We appreciate you. If you need anything, so does having an agent cost. So most of the time, sellers pay a buyer's agent commission. I say most of the time because there are times when that doesn't happen. And if that's the case, then we can negotiate that in your buyer representation agreement that we talked about earlier. So usually that happens if there is a for sale by owner, or if the seller of the property just isn't offering a buyer's agent commission. So again, we would work that out in your buyer representation agreement. But most of the time, more often than not, the sellers pay the buyer's agent commission. It's kind of like you guys have 3 to 5% closing costs, and so do they. All right, guys, well, please reach out to us if you have any questions. Myself or any of my team, they're all here. We have all of your information, and we'll be sending these recordings out. Please share them if you know anyone that is looking to move this year. And don't forget that we will be doing these every month. So keep an eye on your emails and your text messages for the next one.
We have another question.
Yeah. Alexis, so for the THDA program, do we do that first before contacting a lender? You do not. The lender is going to walk you through that. The THDA program, it's all in the back end. I actually have served on the board. It's a wonderful program. It's one of the best programs in the nation for first-time homebuyers, but you need to go through your lender to get it.
Absolutely. It's a partnership that we work with them.
They're wonderful. You're welcome. Rush, I hope your dad's okay. And if you need us, guys, just let us know.
Thank you so much, everybody. You guys have a wonderful evening.
Bye.